So I'm going to work through a few problems for Chapter 5 and just to kind of show you and talk about the terminology. I'm actually looking at an exercise, and this is a lease agreement with a city and a builder. And so we have a city, we have a builder, and we have a lease agreement. Okay, so main thing with these problems and obviously in real life is gathering all the facts and getting all the details. So we're looking at building a new office building. And the fair market value of the building is $12 million. And the city has agreed to make an initial payment of $822,441 and then annual payments after that for 29 years, and we've got a 6% interest rate. So again, just gathering the facts. The lease includes a funding clause which allows the city to terminate the lease agreement if the government does not appropriate funds for the lease payments. The city does not intend to exercise this option unless there's a financial emergency. And upon completion, so still gathering facts, there was an appraised value of $13 million and an estimated life of 40 years. Okay, so there's all your facts from the problem. And so the question asks us to do the journal entries that the city should make for both the Capital Projects Fund and the governmental activities at the government-wide level to record the lease at the date of inception. All right, so we have the Capital Projects Fund. And this is a really good textbook. There's all kinds of examples for you in the book. And I mean, I'm not going to be able to show you every single thing that we're doing in the homework, obviously. But between what I show you and what you see in your book, you've got examples everywhere. So I'm very pleased with this book, and I hope that you are too. So in the Capital Expenditures Fund, on the date of inception, we will show expenditures of $12 million because that is the fair market value. Now I know it appraised for a different amount, but remember this is date of inception. And then we're going to show cash because we made that initial payment. And then we'll show other financing sources, lease agreements. And that's going to be the difference then between the two, or $11,177,559. So there's your journal entry for the Capital Projects Fund. Now in the governmental activities, we show that we have buildings of $12 million. This bothers me. Hold on. Didn't set that up the way I wanted to. Okay, we have buildings, and then we have cash. And then we have a lease, obligations, payable. So it's just different terminology depending on which fund you're in. And again, as I've said before, that's just getting used to that, working in governmental accounting. If you were working in it every day, that would be just easy breezy for you. Because it's new to us, we're still getting used to that terminology. So that's at the lease at the date of inception. I think that pretty much takes care of that. And then they ask us, I think that pretty much covers that problem. They don't really get into more detail. That's just showing you kind of what it looks like. One of the questions says, which financial statements prepared at the end of the first year would show both the asset and liability? So here's your asset right here. Here's your liability. And so which financial statements shows the asset and liability at the end of the year? Again, if you're on a board and you're trying to read financial statements, it's important that you see this, but where you're going to find this at is the government-wide statements of net position. I don't want to say balance sheet, but that's the asset and liability. And remember, we've got this governmental activity. The fund is just showing us there's our estimated expenditures, our cash that went out, and then we have the other financing sources, which is the lease agreement, showing at the fund level, and then the governmental activity, we actually show the liability. All right, so I'm going to go ahead and move on to a different problem. Again, just beginning to get familiar with this terminology. So in another problem that we have, we're going to look in this problem at asset impairment. And so we have a city and we have a building and it had structural damage because of hurricane. So we've got a hurricane. It's been 48 years since the last hurricane. So it's not like this is somewhere where hurricanes hit every year. The building was purchased 10 years earlier at a cost of $2 million. I'm having trouble with my zeros today, as every day. Cost 10 years ago. Again, just gathering facts. It had accumulated depreciation of $500,000. And based on a restoration cost analysis, the city engineers estimate that the impairment loss is $230,000. So that's an estimated impairment loss because of the hurricane. The city expects to receive $120,000 expected from the insurance company. Okay, so there's your facts. So the question says, the first question we have to think about here is the estimated impairment loss, this $230,000, is that extraordinary, is it special, or is it ordinary? And so in this particular one, this one is going to be ordinary. And the reason is, even though it's been 48 years, they are in an area where hurricanes are not uncommon. So it's gathering all those facts. And, you know, people always say you use Google. Well, you do use Google. You've got to go do some research and find out about your area. Because it's susceptible to hurricanes, the unusual criterion would not be met. Now, I think if somewhere in Oklahoma or Arizona got hit with a hurricane, that might be unusual. If it's special, to be a special item, it must be either unusual or infrequent, but not both, but be within management's control. Since this is the first hurricane, infrequent would appear to be met, but because they may be considered frequent for the broader geographic area, they cannot. So it's clearly beyond management's control. So what we have to do is we have to show this as an ordinary expense and show in the notes to the financial statements the details. Okay, and so again, gathering facts, documenting everything that we do and all the decisions that we make. Okay, then it asks us to record the estimated impairment loss in the journal for governmental activities at the government-wide level. So we're in the governmental activities. And we're going to show expenses, culture and recreation. That was the building that was, or I'm sorry, the division that was hit. And then we're going to show that the building decreased in value $230,000. So that is just the journal entry for the impairment, the estimated impairment loss. That's all we're doing right there. I always forget to, good practice, you want to show your description of the journal entry, and I've been working on some financials right now where, believe me, I wish there were better descriptions in those journal entries. And then the insurance recovery, that should actually, when we get the insurance recovery, that should be treated as a program revenue. And again, you can read more about that in your book. So I'm going to do one more video lecture for chapter 5, but I'm actually going to go to another video segment to do that because it's a pretty long problem, and it will help you as you work through problem number 25. And so I'll jump to a new video to do that one.